If you ended up here, it's probably because you want to start investing, but you have absolutely no idea where to begin. If you never invested before, it's okay to feel a little bit intimidated. It's normal to have a ton of questions. And of course, it's completely okay to feel overwhelmed with all the information that's out there. So if that describes how you feel right now, then don't worry, because in this video, I'm going to help you find out when is the best time for you to start investing, at what age should you start, and I'm going to share with you 4 simple tips that you can follow. That way, when you finish up with the video, you'll have a clear plan to follow so you can start investing as early as today. Before actually getting into the content, if you're new here, my name is Ricardo Garcia, and on this channel, I share weekly tips to help you save more money, earn more money, and help you get to financial freedom faster. So if you haven't done so, please consider subscribing to the channel. But most importantly, make sure you hit the little bell icon once you subscribe. That's the only way you're going to be notified every single week when I upload a new video. Now that you've done that, let's get back to the video. But before starting, in order to comply with YouTube's policy, I have to say that I'm no financial advisor, and everything that I'll be sharing on this video is made for entertainment purposes only. What I'll be sharing is based on my personal experience and my personal opinion. So if you want to make the best financial decision, I do recommend that you do some research on your own and seek the advice of a licensed financial advisor if you find that necessary. Now, with that out of the way, let's dive into the video. I recommend that you grab a pen and paper because I'm going to be covering a lot of ground in this video, and I'm going to be sharing a lot of valuable information, so maybe you want to write some of it down. The first thing I'm going to be covering today is how to know exactly when you're ready to start investing. So when someone comes up to me and they tell me that they're absolutely ready to start investing, before I do anything, I always ask them these 2 questions. The first one being, have you paid off all of your high interest debt? And the second one, have you built an emergency fund? Let's start with point number 1, paying off your high interest debt. If you have a mortgage, some student loan debt, or some credit card debt, you might be wondering if you were better off just paying off that debt first before you actually start to invest. And it all comes down to one thing: your debt's annual percentage rate versus your portfolio's expected return. If you have a $2,000 loan at a 6% interest rate, but you can invest the same amount of money and get 8% annual returns, then of course you're going to be absolutely better off by investing your money. But on the other hand, if you have $1,000 of credit card debt at an 18% interest rate, and you still be getting the same 8% returns by investing that money, then it's gonna make more sense to pay off that credit card debt first and then begin to invest. What I recommend you do is that you take a look at all the debt that you have, and then you separate the high interest debt from the low interest debt. Any high interest debt that you have, you might want to consider paying it off first before actually you start investing your money. Once you pay off that high interest debt, then you need to move to point number 2, which is actually building your emergency fund. Because as soon as you start investing your money, that money won't be as easy to access as money sitting on a savings account. If you have money invested in a retirement account, you might have to pay a fee to take that money out, and depending on the type of account that you have, you might even have to pay taxes on the amount you'd like to withdraw. So you're going to be better off by having an emergency fund before you start to invest your money. That way, if something unexpected happens to you, like getting laid off of work, you have enough money ready to pay some of your monthly expenses, at least for a while, without having to touch your retirement accounts. Me personally, I like to keep between 3 to 6 months of living expenses in my emergency fund. So if you don't have that amount saved already, go ahead, sit down and figure out your monthly living costs, and then multiply it by 3 to 6 months so you can start working towards saving that amount. Okay, let's move on to the second topic that I wanted to cover in this video, which is, what's the best age for you to start investing? Well, regardless of your age, you want to be financially ready to start investing as early as you can. That's because the sooner you start investing, the more time your money has to grow thanks to the power of compound interest. I want you to take Katie as an example. Let's say that Katie's ready to start investing at age 19 and she commits to invest $2,000 every single year, which is basically less than $170 a month. And she does that from every year from age 19 until she turns 65. At age 65, she'll have over $1.9 million based on a 10% rate of return. Now let's say that her friend Jane waits until she's 30 years old to invest her first $2,000. And she then commits to investing the same $2,000 every single year until the year that she retires. By the time she's 65, her investment account would only be worth $658,000. If we take a look at the numbers, you can see that Jane almost invested the same amount of money as Katie did, but Katie's account grew 3 times larger than Jane's account. And that's all thanks to time. The more time that compound interest has to grow your money, the more magic it will do for you. I'm not gonna go into detail in this video about how compound interest works, but I'm gonna leave a link here of a previous video that I made where I explain it in depth. The only thing that I want you to understand is that the earlier you start investing, the better off you'll be. As they say, the best time to plant a tree was 20 years ago, but the second best time is now. And with that being said, so what are the steps that you can take to start investing today? Well, here are my 4 recommendations. The first one is you need to start investing in a 401k. If your employer offers a matching contribution, I want you to start investing with their 401k plan as soon as possible. A 401k is an employer-sponsored retirement plan that allows you to save and invest for your retirement on a tax-deferred basis. I recommend that you contribute at least the minimum amount needed for you to get the full employer match, because that's literally free money that you'll be getting. If your employer will match up to 6% of your salary, make sure you redirect at least 6% of every paycheck towards your 401k plan. Let's say you get paid $50,000 a year and your employer will match up to 6% of your salary. That means that if you put $3,000 into your 401k every year of your own money, then your employer will match it up and you'll get $3,000 completely for free. Those are $3,000 on top of your $50,000 salary. And the only way to get that money is by contributing out of your own pocket, because if you don't do it and you don't take advantage of the 401k, your employer will never match it. As of 2019, you can put up to $19,000 a year towards your 401k. And if you're over 50 years old, you can put another $6,000 on top of those $19,000. Most companies offer what they call the traditional 401k, while there are other companies that offer 2 options, the traditional 401k and a Roth 401k. The traditional 401k allows you to contribute money pre-tax. Therefore, it's going to reduce your income taxes every year. But you'll have to pay taxes when you take the money out after the age of 59 and a half. With the Roth 401k, you'll have to pay the taxes now on the money you'll contribute, but that money will grow tax deferred, and when you take the money out at age 59 and a half, then you can enjoy all of that money and the gains that it made completely tax-free. To take full advantage of a 401k match program, if your company offers one, all you have to do is follow these 3 simple steps. You're gonna have to sit down with your employer and enroll in their 401k plan if you haven't done so already. Then you need to figure out how much you need to contribute to get the full company match and start contributing at least that amount. Make sure you set up automatic contributions so that your money is sent directly from your paycheck to your 401k account. If you're not an employee but you're self-employed, then you can take advantage of something similar that is called a solo 401k. I'm not going to be covering it in this video. Maybe I'll make a video about it later on, but if you're self-employed, I encourage you to take a look at it. If your company doesn't offer a 401k plan, well, you already maxed it out and you still have some more money to invest, the next thing you need to do is open and start contributing to a Roth IRA account. A Roth IRA is like a Roth 401k, but you don't need to have an employer in order to open an account. In fact, any individual can open a Roth IRA account. All you have to do is call your preferred financial institution and get it set up. There are actually 2 big advantages of setting up a Roth IRA. The first one is that the money you're investing will grow completely tax-free. And second, you're not going to owe any taxes when you withdraw the money in your retirement. So if your account grows by hundreds of thousands of dollars over time, you're not going to owe any taxes when it's time for you to start using that money. As of 2019, you can put up to $6,000 every year into a Roth IRA, and if you're older than 50 years old, you can put an additional $1,000 every year. Okay, so moving on to step number 3, and this is one that I've talked about in previous videos. I want you to take advantage of apps that help you save and invest your money. Now that it's 2019, it's easier than ever to start investing. You can do it right from your smartphone as you lie in bed or you watch Netflix, thanks to apps like Acorns or Stash. As you may know, me personally, I use Acorns because I really like their concept. The way that the app works is that every time you go out and you make a purchase using your credit card or your debit card, the app will automatically round up your purchase to the nearest dollar amount and will save and invest that spare change for you. And I shared this example before, but I think it's worth showing it again. Let's say you go ahead and you create your Acorns account. Next time you go to a coffee shop, you go to the counter and you buy a cup of coffee for $2.85. What the app will do in the background is that it's gonna round your purchase up to $3 and it's gonna invest those 15 cents automatically for you. And I know you might think that that doesn't sound like much because every time you purchase something, it's only gonna be putting in some cents here and some cents there, but it ends up adding really quickly and your Acorns account will grow really fast. I opened my Acorns account about a year and a half ago, and by today, I already passed the $1,700 mark. Another cool thing about the app is that depending on your goal, it will allow you to choose from different types of portfolios. You can choose anything between a very conservative one to an aggressive one. If you feel like giving it a try, I'm gonna leave a link in the description below. All you have to do is click on the link, create your account, and you'll get $5 completely for free. And finally, last but not least, let's talk about step number 4, which is basically opening your own brokerage account to invest in stocks. I wanted to save this one for last because it's the only type of account in this video that doesn't offer you any tax advantages. Any money that you want to invest in this type of account has to be after-tax money. And any capital gains that you make on your investments would be subject to tax once you take that money out. In my opinion, it's better to take full advantage of a 401k and a Roth IRA before thinking about starting a brokerage account. But if you're already maxing out your 401ks and your IRA accounts, then it's time to invest your money through a brokerage account. So where do you start? The first thing you have to do is find an account that fits your needs. Thanks to the internet, you can open a brokerage account online in just minutes. But before opening one, you might want to take a minute to look if they have any account minimums or simply to look how much they charge for each trade. My favorite ones out there are TD Ameritrade, Fidelity, E-Trade, Charles Schwab, of course, that's the one I use, and then Robinhood. Most of these won't ask you to have a minimum on your account, and almost all of them offer free trades. So do your research, pick the one that you like the most, and then go ahead and open an account. Once you do that, you should be ready to start investing. But there are a few things that I personally do that I want you to keep in mind before you start investing your money. The first one being that I invest for the long term. And this is mainly because there's a big tax advantage when you invest for the long term. When you do short-term investments, which are investments that you have bought and sold in a period of a year or less, you'll have to pay short-term capital gains tax rates equal to your ordinary income tax rate. Well, on the other hand, if you hold an investment longer than a year before you sell it, once you sell it, you'll be taxed at the long-term capital gains tax rate, depending on your taxable income and filing status, which end up being way lower than short-term capital gains tax rates. For example, if you're a single filer, this will be your short-term capital gains tax rates. While on the other hand, this will be your long-term capital gains tax rate. So you can see that investing for the long term makes a significant difference in the amount of money that you'll be able to keep in your pocket because you won't have to pay so much in taxes. Another thing that I want you to keep in mind is that it's actually very tough to beat the market over the long term. So when investing, I just look to emulate the market returns. A lot of people who are new to investing, they come in thinking that they can actually beat the market, which cannot be further away from the truth. According to an article from CNBC, after the past 10 years, 85% of large cap funds underperformed the S&P 500. And after the last 15 years, nearly 92% are trailing the index. So if most professional mutual fund managers can't beat the market and they spend their entire lives looking at these companies and looking at graphs, what makes you think that you can actually beat it? You and I might be able to beat the market one time or a couple years in a row, but can we do it over a 20-year period consistently? Because I doubt it. So I know I'm better off just by emulating the market returns. In fact, Warren Buffett, which many consider to be the world's greatest investor of all time, said that 99% of investors shouldn't even try to beat the market. He said that they would be much better off just by investing in a low-cost S&P 500 index fund. So that's why I invest in low-cost index funds. If you want to take a look at different options for you to invest, I encourage you to go to Vanguard.com and take a look at the list of ETFs that they have there. I'm going to leave a link to that in the description below in case you want to use it. Once you get there, you'll find a wide range of low-cost index funds to invest in, ranging anywhere from US bonds to US stocks to international bonds and international stocks. One of the things that I like about this website is that it allows you to see the expense ratio of each one of their index funds. which is another thing that I look at when I'm looking for investments to make. I'm always overly careful about management fees. Everyone likes to talk about the benefits of compound interest, but nobody talks about the real danger of compounding management fees. Let's jump into this example so you can see the big difference that small fees can actually have on your money. Let's say that you're choosing between two similar investments and one has a 0.04% expense ratio, while the other one has a 1.07% expense ratio. For both investments, you put down $10,000 and you get a 9% rate of return for the next 10 years, which means that you would end up with $23,673 at the end of year 10. If you invested the money in the fund with a 0.04% expense ratio, you would only have to pay $95 in fees. Whereas if you invested in the fund with the 1.07% worth of expense ratio, you would have paid $2,436 in fees in the end. That's a difference of $2,341. That's a big difference. That exercise that we just did was for a 10-year period. I just want you to imagine what would happen if we would do it for 50 years. What seems like very small fees will end up taking a big toll on any investor's portfolio. So always look for low expense ratios when choosing where to invest your money. And with that, I'm out of tips for today. I hope that was helpful to you and that by now you have a better understanding of the moves that you need to make to start investing your money. If you found this video valuable, make sure to let me know by smashing that like button, and feel free to share it with a friend who wants to invest but doesn't know where to start. If you haven't done so, remember to subscribe to the channel and don't forget to hit the little bell icon if you want to get notified every week I upload a new video. If you're subscribed to the channel but you haven't tapped that little bell icon, you won't be notified when we upload a new video and our channel's new content won't be appearing in your home screen. And that same thing applies to every channel out there. Because when Google acquired YouTube a few years ago, they made the subscription process a two-step process. I know it's confusing and it doesn't make any sense. It kind of makes that subscribe button useless, but it's been like that for a while and I just wanted to bring it up just in case you didn't know. But anyways, thanks for watching guys and thanks for the support. I'll see you on the next video.